Good morning, everybody. Welcome to the Flow Show. I hope I'm not going to see too many of you here this week, even though that's counterproductive to us. But it's holiday week, so you should all be thinking about winding down, going and taking a nice break, getting ready and refreshed for the new year. Morning, Kay. You in wind down mode?
Good morning, Ryan. I'm in reducing risk mode, let's put it that way. Yeah, it's still a week, still some stuff going on, so we'll keep an eye on things. But yeah, I'm not going to go in anything like sizable like I can do over the year. But yeah, it's this time of the year where flows come out of the woodwork that are not necessarily in line with data or trends, even though trends in this market is a big word. So yeah, we are in keep it sensible mode.
Yeah, and stay nimble for this week if you traded it. Right, well, let's get cracking because there's plenty to talk about today. The Bank of Japan is considering lifting its negative rate in January. That's according to the chief strategist at the All Nippon Asset Management Company over there in Japan. So some expectations there for what the BOJ are going to do in the new year. We've also had the big business lobby Kaidaran chief saying that the BOJ should normalise monetary policy as soon as possible. That's not a new call, and it's following some of the others as well who want the bank to normalise. Well, they've got to play their part as well by getting those wages up. But as you can see, a lot of sentiment is changing around the BOJ, and that's going to continue into the new year. Right, over to the ECB, and it's really a bit of a theme that we've had from central bankers in general between the Fed and the ECB. A lot of them pushing back against early rate cuts. ECB Centeno was one of the first out. Obviously, now we're past the meetings, the stable door has opened and they could all come out with their comments. So Centeno, one of the doves, said said inflation has been falling faster than it rose, but we haven't seen big wage effects on prices yet. One of the hawks, ECB's Wunsch, said a March interest rate cut is highly unlikely and investors are too optimistic the ECB will begin cutting rates in March. He says that the slowdown in wages is the key to the timing of a policy shift by the ECB. Another hawk, ECB's Nagel, also looks like he's finally thrown in the towel following Holtzman last week. Says the ECB has reached a rate plateau with a high likelihood. Says it's too early to consider ECB cuts. ECB's F.A.C.E market pricing for both the start of rate cuts and totality of cuts in 2024 is excessive. Recent accommodation priced into rates is inconsistent with a stance appropriate to get inflation to target. Inflation will rebound in the first half of the year, and ECB should reassess its policy outlook only after observing this trend. So again, another pushback against those early cuts and even the possibility that hikes aren't done yet. There's been a sources piece out, a general piece out last week as well, late last week, saying that policymakers don't expect to change their message on keeping rates steady before the March meeting, and that they say any cut before June is looking difficult. So this is what we're going to have to put up with now and going into the new year, this constant pushback against the market pricing cuts and when those are going to happen. Bank of Italy has cut its 2024 GDP forecast to 0.6% from 0.8%. It has raised its 2025 to 1.1 from 1.0, its prior forecast. In the data, we've had the German IFO numbers this morning, and not looking too good on that either. Oh, where's it gone? Ooh, it's always a big one on a Friday. There we go. So the business climate index not rising as expected, instead falling back 86.4 versus 87.2 previously. Come conditions also going backwards as well, was expected to rise 88.5. Expectations doing the same thing, 3 for 3 in negative numbers there, 84.3. So we've seen a little bit of positivity from some of the other numbers in Germany, but not so the IFO. So nothing majorly happening for Germany just yet. Bit of data from the US last week as well. We've got a few bits and bobs, industrial production, manufacturing, all coming in positive, but missing expectations. We also got the flash PMI number, which came in at 48.2, a move backwards on that one. Services, though, improved there. We also got the Empire State, which came in at minus 14.5, and some soft numbers there in the components. Employment down 8.4%, larger than the minus 4.5 previous. Numbers looking a bit softer all round there, including new orders, but 6-month expectations rose to 12.1 versus minus 0.9 last month. So some people expecting a little bit of a pickup in the months ahead. So overall, the details there, again, numbers straight after. The services probably washes out a bit of the manufacturing weakness there. It's a pattern we've seen time and time again amongst these PMIs, the improvement there doing better. But the market didn't take too much, put too much concern on the data. What they did put concern about was Feds Williams popping up and really doing a bit of a pushback against Powell's message, or the market's view of Powell, and getting all dovish. Says we aren't really talking about rate cuts right now. It's premature to be thinking about a March cut. Is focused on whether policy is in the right place, and the Fed must be ready to hike again if needed. The Fed's rate cut views depend on individual officials' views, and there's still highly uncertain. There's still high uncertainty for the economy and inflation. The market's reaction to all the news has been quite large. We need policy to move back to more normal levels over time. Now, bit of a strange one, because Williams actually gave a stronger message than Powell has in the last couple of weeks, particularly at the FOMC. So there's a few train of thoughts here. But before I bring Kane, we'll just continue with our Fed member. Bostic as well. He's been probably the loudest proponent of that rates were at a peak and there's no need to hike further. But he is also pushing back on early rate cuts, as rate cuts are not an imminent thing, although he has instructed staff to begin developing possible principles and thresholds to guide the process. I don't know why a central banker needs any of those to determine rate cuts. They've been through this enough times. I should know what to do with them by now. But anyway, now this stood out as well. The Fed FOMC median forecast for rates were for 75 pip cuts. Now, this is one of the big doves. He only sees 2/4 percentage point cuts in 2024, with the first sometime in the third quarter, assuming that the expected progress on inflation continues. So he's one cut less than the median, and this is one of the doves. He says Fed officials are pretty much in the same place right now, that policy is at a peak, but that's conditional on inflation progress continuing, which could be classed as a bit of a hawkish comment. If inflation bounces, he might be back towards a hike. It will still take several months for the Fed to get an adequate signal and develop enough confidence in inflation's continued decline to reduce rates. Lastly, ECB's Goolsbee says it's too early to declare victory over inflation. Kay, you mentioned a point that I raised a week or so ago, that it might do the US a bit of good if there's a bit of loosening of financial conditions just by the jawboning. But this has been a strong pushback. You'd expect this sort of talk from Powell more than the underlings, wouldn't you?
No, absolutely. Absolutely. This is, I'm usually not a conspiracy theorist, but this really, I said in the room this morning, I don't know, it raises a bit my antennas, especially the combination of all those comments, because now we're seeing those or middle field Fed officials fighting back against something that Powell has been saying, and who usually is not among the doves, right? He's actually usually leaning a little bit more to the other side, but. Yeah, the conspiracy theorist in me says that I find it very strange, this whole sequence of events, because the day before the Fed, we had Yellen coming out saying that they were in a good place and she didn't see any rate hikes anymore and we were saying like yeah she's talking her shop because the US Treasury needs to fund all those deficits and it just I can't keep away from thinking that they had a bit of a duet there, Yellen and Powell saying like yeah all right let's give Yellen what she wants, and let's give the market a bit of what they want. And but it does not apparently reflect exactly what was going on at the FOMC. That is now my finding, because if you would be a dove at the FOMC, you would say that yeah, what Powell said was absolutely spot on. I'm in the lower end of the dots, but no, they actually said the opposite, and especially Bostic saying that he only sees two cuts, and he's a market dove. So all of this is like really, I find it very strange, and this whole ballet of. Of Yellen, the FOMC, and then the commentators afterwards fighting actually back against what Powell was saying. So I'm a little in doubt here about what to really think about it. And if I would be well, a bond trader also, I would also be a bit cautious with what I'm doing here, because we're seeing a lot of calls now saying that yeah, okay, Powell announced the pivot, whatever you see in the 2-year, 5-year, 440, where's the 5-year? Let me quickly have a quick look at it. Oh, the 5-year is actually already below 4%. But yeah, and it's time because Powell told us to get in there for the more longer term, and I find it a bit dangerous, all of it. Not not that they won't cut. I mean, it's pretty clear that 2024 is the year of the cuts, but then we don't know who is going to cut the fastest and the hardest, or the earliest. But yeah, this whole thing is raising my antennas a bit and saying like, what have they been playing at last week? You know?
Yeah, no, I agree with that. But I think that a lot of it is rallying against the early cut expectations. This March. I joked about it in a room over a week ago when all the banks were cutting their forecasts. It was coming from Q4 to Q3, Q3 to Q2, August to June. I said you might as well just stop it. Everyone should just predict March because that's where it's all going. And here we are, everyone's jumping around in March, and literally every member, or whether it's the Fed, whether it's the ECB, are trying to push back against March, and the market getting too early with cuts. So I think the Fed heads are right to push back on that. But I agree with what you're saying. It's strange that the head man doesn't come out with such strong comments, and he leaves it to the minions, so to speak.
And he actually leaves it to the doves. I mean
Yeah.
that to me means that there's a bit hard. I mean, it's always tough to say because we are not there, and we are retail traders now. We are not like in big banks or big asset managers or whatever to have like a discussion in depth or looking at the books or stuff. But it all looks a bit like um, we know that next year Treasury is going to have to issue another fierce amount of bonds. But let's keep it all as cheap as possible. The, and yeah, that's where it all feels a bit strange. That because Powell is not talking over the same line, and he's the boss. I mean, he's the governor. but he's not talking the same words as even the doves of the FOMC are talking. So that's where I find it a bit strange, and where if I were on a bond desk, I would say like, well, hang on a little bit and have a very close look at the Treasury issuance calendar starting the new year, because if Yellen starts to overload the market with bonds, perhaps some repricing will have to be done again. And the calls for March. Oh, hold on. I need to take something, Ryan. Just
yeah, go ahead, mate. Yeah, go. I can imagine what Kay's going to say about the calls for March. That they're a bit over-excited, perhaps. But we still got a big disparity, a big divergence between what the Fed expect rates to do and what the market expects rates to do. And we're going to be trading that, around the data points intraday as we move forward, whether that divergence closes or opens further. Right, I'll move on to the Bank of Canada. Because we had Macklem speaking as well. Again, another one pushing against early cuts, saying it's still too early to consider cuts. We're still discussing whether we raised interest rates enough and how long they need to stay where they are. We are not taking further increases off the table. Says we still need more downward momentum in core inflation, and we'll only consider cuts when we're clearly on a path to price stability. A bit of a warning for the economy. Says the next 2 to 3 quarters will be difficult for many. So again, you're getting a theme from these guys. Yes, they know they're potentially at the top with rates, but they're going to try and play it coy with cuts down the line. Right, moving into a bit of transport news, let's call it that. There's been several shippers, shipping firms issuing warnings about Red Sea travel. Maersk says it's told all its container ships to pause Red Sea voyages. The German line for the container line, Hapag-Lloyd, says we paused all sailings through the Red Sea until the 18th of Dec and will decide after then whether to pause sailings further. Euronav has insisted ships have the option to avoid the Red Sea. This is all due to what's going on there, the Houthis and stuff backed by Iran, whatever you want to call it, however you want to spin it. There's been various missile attacks on vessels traversing the Red Sea. Obviously, there's always a lot of US Navy over there as well. Has always been a hot spot, but it's picking up of late. Think of this in terms of growth stories. If ships have to divert, it could be delays to stuff being transported around the world. A bit similar to the Panama Canal blockage thing, and also whether we start to see backlogs at ports and things like that. It just has a bit of an impact, like we saw over COVID in China with GDP and things like that and activity. So it's not something that for now would have any lasting effect, but again, headlines popping up on the same theme. There's 3 shippers who are issuing problems or saying there's problems there and may have to do something about it. That could impact the traversal of goods around the globe and that area. Just one to keep an eye on. Right.
I'm back, by the way.
Back yet. Oh, he's back. Cool. Right. Well, yeah, something we need to look at for now, and that is the yield space and what's going on. We've had all these, we've had the FOMC and all the moves. So I just want to look at a few yields and just look at the differences and talk about this rate divergence we've got going on. Okay. Now, this isn't an exact science. Okay. You can't equate one thing to another exactly, but you can use it as a general rule of thumb. So 1-year yield, for example, we know the Fed are expecting 75 pips of cuts, a median rate of 4.6%. Well, here we are, some 50 pips above that. Okay. 2-year yields, they're expecting the Fed fund futures to be a median of 3.6%. in 2025 or by 2025. So here's 2-year yields, which take that into consideration. Okay, so 3.6%. Okay, we're well above that. We're some 80 pips above that expectation. So as far as yields go in the short term, it's not yet pricing the level of cuts that even the Fed expect. Okay, which means there's still some room. These are assets that are not yet as excitable as some of the other assets in the market, like rate futures and that sort of thing. So there is a bit of disparity between the assets on what's expected for rates. 10-year yields are obviously a big driver for what happens in the dollar. Okay, now what rates are in 10 years is another question altogether. But what we have seen is a significant drop in yields. Okay, this one you need to look at just to gauge what the dollar might do. Dollar's looking a bit firmer this morning, well, against the yen anyway. But for yields, we've stopped dropping. Okay, over the Fed, we kept coming down and down and down, busting through the levels. Now we've had a little bit of a pause around this 3.89, 3.9 area. If we break below there, that's likely to lead to the dollar getting sold off a bit more. And then we've got a big level down around 3.7%. So look at this for your general gauge for what the dollar might do, particularly this week. We know it's going to be a bit of a funky week, so you always need to be watching yields. But for the longer term picture, keep your eye on the shorter end as well, just to see what it's telling you about where rates are expected to go over those periods compared to where the Fed think they are. Kay, I know you said you were looking at rates and the 5-year and whatnot.
Yeah, sorry, got called off.
Yeah, that's all right. Do we need to be particularly careful this week? I mean, we do have a bit of data out, which I'll point out in a minute. But yeah, this time of year, I think it's a lot about looking for asset to asset divergence, perhaps, like if the dollar moves out of whack with yields and something like that.
Well, we do actually have a bit of issuances out this week as well. I mean, there's a few short ones, but there's also a short 2-year and the 5-year tips this week. So that may have an impact on what's happening in yields. But yeah, I think it's kind of logic where we stop because of what the food that Powell gave to the markets. But also we can't, if you look at the economic data as well, they're not yet falling out of bed as we have seen for core CPI a bit sticky, but Powell, and that was the strange one as well over the meeting where he said like all 3 inflation indicators are coming off at the same time. So when it suits them, they're looking only at core CPI, but when it's going the other way around, he's looking at all of them. But yeah, I think it's a kind of logic where we are now. If you look at the 2 years, we're at 440. That's 20 BPs below where they expect the Fed funds to end up. That's really the judge that the market is looking at more than the 1 year. And then you have those 3 months Fed funds, right? Futures. They are well. I mean, you could argue that they are pricing in half a cut for March, but really the cut is like fully priced in for April now. The first cut, that is. Yeah, I think it's a bit logic where we are now. But if you look at the whole thing, that where the market thinks that we may see, when I look at December, we are at nearly 4% now. So that is 130 BPs cuts. That's overdone. So I guess somewhere not too far from here, unless we get like really weak data towards the end of the week, and we get like a surprise move into the end of the year. I guess we are sort of where we can stabilize, even perhaps bounce just that tiny bit. Yeah, that's where I think it's at now.
Yeah, yeah. And for those that don't know, the CME FedWatch tool is a handy thing to look at just to see what the expectations are for rates, and you can see them over the different meeting periods as well, where this is percentages of where that rate likely to be by that particular time. So if you want to keep an eye on the rate expectations, then as I said, the CME FedWatch tool is a handy one to look. Just Google CME FedWatch and it will pop right up. Right, dollar yen has had a bit of an uplift, and I said this in the room this morning. I'm expecting this to perhaps creep back up. Obviously, on the back of the pushback from all these Fed heads, but we are in the BOJ zone, and the market's going to be starting to reprice, whatever you want to call it, get its expectations lined up for tomorrow. Given the pushback we've had from some officials, sources, and whatnot since those UEDA comments, which sounded quite hawkish, it's no surprise that the market's scaled down expectations for tomorrow. Personally, I don't see anything coming. UEDA might push back against those comments that he made, saying they were, again, misinterpreted or subject to a lot of ifs, buts, and maybes. If that's the case and he's still pretty cautious, then I expect this to rally further. And it might be a bit of a last hurrah if it's a decent rally up on that, because whatever happens, the market knows that we're potentially heading towards tightening, and it's just a question of the clock and calendar. But if he does keep a little bit of I wouldn't say hawkish, but a bullish opinion of the economy, of wages, of inflation, then any hint that those comments last week were part of discussions or they're on the table as being discussed, then I think we might get another leg lower. I think the likely outcome for the Bank of Japan is that it's a bit of the same old, same old. They acknowledge that they're en route to tightening, but there's still a lot of speed humps in the way to get there, and they need to see all those resolved, including the wages next spring, before they think about normalising policy. So that's, I think, the likely outcome. But I think, given that what we've had from these guys of late, Kay, I think it's going to be volatile on both sides of the trade, really.
Oh, it could be more, yeah, I don't know, a yo-yo than really taking a direction. My expectations is for no change, but continue to gently change this wording into saying that they are getting ready. So, I mean, it could be like one of those other Bank of Japan meetings where you see a move before, you see an acceleration afterwards, and then you settle back down. Because it's pretty clear that, okay, they are on the path. That's what we have been saying for a year now, but that path is really slow. So I expect it just to continue. And I know that there's a few people in the market, but they are in the minority, thinking that we may see a surprise YCC move again this meeting. But I don't see any reason why, because the JGB 10 years are trading around 66 BPs, which is still very far away from the 1% bar that they put in place over the one before last meeting, if I'm
Well, let me just ask you quickly on that.
Yeah.
Would that not make it a better time to widen the YCC when there's no pressure? Because they've always seemed to widen it when there was pressure on yields, when yields were pushing up to the top of the YCC, whenever it was set. Could they do that with that and do this and make it a less pressurized move?
Well, no, I don't think, because they even the longer term expectations, and even the expectations of the big market participants, the Japanese ones, they expect the 10-year yields to anyway cap anywhere around 1.25%. So that would really, to me, that would really be a surprise move, because widening it again, why would they widen it, and to what level? 1.25%, 1.5%. And I don't think it would help in any way to do it now, it would just add perhaps some nervosity in the market. But it would be, of course, if that's what they do, that's a real hint at saying like, all right, next meeting it's bingo. We are getting out of negative rates. That would send a very strong signal actually, if they would do something to the YCC over this meeting.
It's seen as a preparation move rather than let some pressure out of yields because they're bumping up against the ceiling.
Yeah, if they would if they would be at 0.9%, they may do it again, but they're at 0.65, 0.66%. I mean, why would they actually do it right now? If and when they start to move out of negative interest rate territory, I do think at one stage there is a fair chance that they abandon YCC.
Yeah.
Once and for all, and it's just, again, I don't see the necessity to really widen it unless they want, unless it could be a dual signal. If they widen it now, I think the market goes balloony over the year end, because then they say like, all right, this is it now we're going on the next meeting, and then you're going to see probably a full month. What is it? Full month and a half of speculation. Yeah.
Might be too much for them to want to get into that zone.
Yeah, because then they're putting pressure on themselves, saying that because they also said they would do unscheduled JGB buying. So I think they just want to avoid them to put themselves under pressure. And don't forget that if they widen the YCC, yields are going up, and the government is going to be all over the way. They're saying like, hey, hang on, we only had 15 years to prepare for your hiking rates. I need another 5, you know. But yeah, I don't think it's too useful right now to do it. The most stable thing, and that is still what Ueda wants to do, looking at what he has done, is to just continue to change the wording and saying like we're starting to see evidence that because we had an okay Tankan as well, we're starting to see evidence that the system is ready to in the next few meetings, conditional to wage hikes, yada yada, that we are going to normalize. That is a clear possibility in my opinion.
Yeah.
But changing YCC.
Sorry, mate.
But changing the YCC, nothing is disruptive right now, because don't forget the reasons why they also said that they would change the YCC, because the market was a bit disrupted and there was too much going on, and the regional banks were in trouble. They are asking to really normalize, but already widening the YCC is giving them a little bit of breathing room for the more medium term versus the short term, right? That is where I think what they could do if they send a message of normalization tomorrow morning, probably the JGB yield is going to move a bit closer to the 1% mark again, and then we will have to see how the Bank of Japan reacts.
Yeah, very much so. I'm just looking at a headline that might be the reason why we've seen this little spike up in dollar yen. Nippon Steel apparently going to buy US steel for over 7 billion, according to the Nikkei. So as can often be the case, the market sees an M&A headline like that and just does the deal already in potentially in the currency to what is the market might expect. So let's just cross the line, the headwires, the news wires. Now that Nippon Steel are going to buy US steel in a deal worth over 7 billion. Another headline saying the total enterprise value is 14.9 billion. So yeah, that might be why we're seeing dollar yen on the up. Also seeing Loretta Mester popping up as well. Fed's Mester saying markets are a bit ahead of the central bank on rate cuts. Speaking to the FT, so it's another pushback from another Fed head. That's all going to continue. Anyway, so yeah, back to the yen, dollar yen. Yeah, I'm expecting it to push up a bit, and likely we see it rising over an unchanged Bank of Japan. Where it goes to is anyone's guess this week. We keep saying it, we keep warning it. It's going to be, it has the potential always this time of year, and particularly into the year end, to be a bit funky. You might see moves that don't make sense, and what I'll be watching is for anything extreme. You know, if dollar yen goes from here to 148, you know, into the end of next week and the end of the year, I'm going to be very tempted to smash the granny out of that potentially. If there's no news, no headlines, no nothing. So watch your year-end flows, watch your holiday flows. If you get something funky happening and it's outside of the fundamental or central bank picture, that's a potential trade to look at for a fade into the new year. But just otherwise, just be careful with any of these moves. If you happen to get a move that goes your way unexpectedly, take some money off the table, lock in the rest, and just in case it all reverses. Ali, you were saying that, I don't know if I can find it. Where's it gone? There we go. You are that the Bank of Japan 2023 was very speculative for the Bank of Japan. Yeah, it's been a, you know, the trend this year has been pretty one way, dollar yen rising. Not too much on the speculation front from the Bank of Japan coming into that, although we obviously know a lot of the market was expecting them to move towards a tightening door. So this really is the one for 2024 if they finally pull the trigger. This move down is obviously part of what's happening in the US, a large part. So we've only really just seen in the last few days the market getting on really into the BOJ side of things as well. So it just gives you a bit of an idea. You're going to have potentially the Fed cutting, and if they're forced to cut more than they expect because the economy is tanking, and suddenly the Bank of Japan are hiking, it's a double win for this to go down. Do you think we can get all the way back down to the 130K on that cocktail?
Okay, of course, there's always the dollar, right? But I would say purely on the Bank of Japan, if the speed is how we expect it to be, is that they are going from minus 10 BPs to 0, and then perhaps a couple of quarter percentage increases. I don't think it's enough to keep the dollar yen down on its own. Really, I may not do much cash to start with because we know the market is always very eager to push the yen one side or the other. But if I see levels back in that 136, 138 zone, I may buy some options back to the top side. All else equal, of course, if at the same time US data start to roll over, especially the jobs market, I would say at this point, because I think the CPI inflation is going to run a little bit in concert. I mean, the majors are going to run a bit in concert, keeping away Japan, of course. But all else equal, I don't think that rate hikes in Japan will warrant moves to undo, let's say, the whole move down to 127. It's not my base case, let's put it that way, right now.
Okay, mate. Ali thinks the BOJ will not react in 2024, and dollar yen will not go back down. Well, that's
okay.
We'll have to see how that one turns out, Ali. And but yeah, right, Katie, do you want to take it and have a quick look around, and then I'll have a quick look at what data we got this week, and before we close up.
Yeah, sure. Let's first have a quick glance at what as Ryan was already mentioning those interest rates, what the differentials are doing. And again, these are the short-dated euro and dollar differentials. And again, we are seeing relatively the same things. So we come out Powell and Lagarde, okay? Powell and Lagarde, here we go. Tightening the differentials between the Eurozone and the US tightens. We are trying to get out of the box once more. We're trying to get out of the box. And again, okay, this is Williams, Goolsbee, Bostich fighting back. And we are back in the middle, okay? So that does not tell me that the euro dollar on its own, barring events, barring data, barring year-end flows, because we're the 18th of December, right? So as I've already said at the beginning of the show, watch out with what's going to happen now, because people have flows, and regardless where we are, that they have to execute. I don't know which ones they are right now. When I look around at equity markets and stuff over the course of the year, I would say perhaps, but again, I'm sticking out my neck here. Perhaps a bit sterling buying also going on because of the underperformance throughout the year of the FTSE compared to other indices. But then you have this whole bond move as well, which has taken place. And if we look at the what the market is usually looking at the sterling differentials. So we had this run up in the cable. We had the Powell Bank of England move, and what happens? Here we are again. We're coming back again to the middle of the road. And again, this is another one that based on this, based on yield moves, based on bond moves in different markets, there is very little that tells me that we are going to take a trend based on yields into the end of the year. And we've been talking about that as well with Ryan already earlier. There doesn't seem to be a lot of stress liquidity-wise for the end of the year. That was one of my fears, or let's say one of the things that I was watching to see if there would be any liquidity issues into the end of the year. It doesn't seem like it right now, okay? You never know what's happening in the last couple of days of the year, but it doesn't seem happening right now. And as Gavin says, yes, we are still in those boxes, and that for us, I think if you want to trade it short term, if you go to the edge of the box, there is very little reason to move out of it as well. So that could be your little intraday trade if you want. Besides some levels, so the levels to me. So we had this again, a rejection of the 110. By the way, we're coming out of a year in euro dollar, which has seen since the global financial crisis, since before the global financial crisis, the tightest range of a year in euro dollar. And looking at those differentials that I've been showing you constantly, I think it explains a lot, all right? Those differentials explain a lot because inflation, for one, has been running relatively parallel to between the major countries. We had spikes above and below expectations on each side of the pond, but if you look at how they moved in the big lines, they've been moving together, all right? So I think that is one of your reasons as well why we've had relatively tight range on stuff like the euro dollar, for instance. Also, even if you look at the employment picture in the Eurozone is still not too bad either. And similar happening in the US. Right, for the short term, I think we have a little bit of resistance here on the euro dollar. We had this spike 110, then we had Williams, Bostic, and whatever. We've seen services hold up in the US. We've seen the same thing. Manufacturing is doing weak, but that's the same thing across the pond. And so now for the intraday, if you really want to look at a bit of resistance, I'd say somewhere around 139, 40. 35.45, 35.42. That's your intraday little resistance. That's a good observation as well, Gavin. That euro dollar is still not far away from its year's open around 108.60, which has been a crossroad, right? Throughout the year, every time we've been there, there's been activity around that zone. Perhaps some people have been some clever option players have been playing that range. And on the short term, well, then there we are. I think your Friday low is a bit of a support there around 108.85, 109 the figure, and then your 108.60 there. Again, I'm not sure. Today, I think, let me just have a quick look at the calendar. No, today we're done. We are done. We just have short-term options. We are done. We have a bit of a speak. We have Schnabel speaking, ECB Lane speaking, but really we have a bit of housing data in Canada, but that's really it for the rest of the day. So barring any unexpected flows, I would expect we hang around in this range today, and we are just going to wait for what the Bank of Japan is going to bring us tomorrow. Quickly on the euro sterling, I was a little bit short, scaled down, and then I was looking at this little resistance here. I could have kept it until here, but I just think that it's getting to be a bit random. So I had my entry just above here, somewhere here, scaled down a bit, and I took the rest back roughly where the original entry was. I'm going to go really neutral there. This is still one though that I'm going to keep an eye on for the for the year-end flows. As I said, if I look back quickly on the year-to-date performances, the FTSE is still very much underperforming all other major indices, okay? If you look at, for instance, the S&P has done 23% year-to-date, the FTSE has done 2%. If you look at the, where is the Euro Stocks? Done 19.5%. If you look at this, the only ones that have underperformed the FTSE are the Chinese, that for one, and some exotic ones. But FTSE is the weakest one among the major indices. So based on that, I'd still be a bit careful with what's happening on the sterling. We could have like this late end of year revival, and perhaps we could see a bit of a move back down here. But the market has shown us that it's really going to take something to break back down and go back down to the prior low. So going neutral here on this one. One that I'm still running is this Euro Aussie. Still promising. We had this little bit of a spike up here, but it's coming back fairly easily to the downside. We also had a line overnight that Australia is hopeful that China drops the wine tariffs in early 2024. This is still one that I reckon may have a bit of more legs going into year end. Seeing my relative optimistic is a big, but my relative positive stance towards risk because of lack of liquidity issues and things like that in the market. And we know that antipodians like a bit of positivity, so that is perhaps one that also could have a little bit of a continuation of the move. My positions are small and risk-free right now. This is one that I'm looking at. I know Ali is often looking at gold. I think we are in the range here, 20, low 20s, starting from 2015 down to 2006 or 7 again, probably a bit of support, but equally on the top side. 2032 a bit in the middle, and then have a look at what's happening if ever we get back into the 2040s. Without more data, I'm not sure that this can really move a lot, okay? I doubt it. I think today is really a transition day, and perhaps tomorrow being the last one for the year, the last flow show of the year at least, we could have a look at other stuff. So for the Bank of Japan, yeah. See, this is where I think if ever we get back into this zone here, this is 136, 137.5. There's going to be a lot of thinking to be done if we get down there. And base case is that we are not going to get it over next night's Bank of Japan. We are also turning around the 200 DMA here. If the Bank of Japan is neutral, of course, there's always this thing about you can't stay long yen for long because you're still paying away 3.5–4%. But we could just die the year around this around the 200 DMA. Why not? Because then we are in the middle of those bigger ranges that we have been trading. I don't know what the market is going to do. Speculate about something late into the Bank of Japan, or taking it up again into the 143s. I think Ryan may be spot on. And since there's not that much expected, we just drift a little bit higher, and then tomorrow, depending on what the Bank of Japan decided, I'll have a close look at what's happening in the crosses market, because I do think in some of those crosses there is a bit of things to look at, especially this euro yen in this zone here, 154, 154.80, and we are not too far away from it. This is one that could really decide upon what the next move would be for the next few big figures. Okay. And Ryan, with that, I give it back over to you.
Yeah, thanks, mate. I'm just looking at the clock. We'll call it quits. We can have a look at the rest of the data tomorrow that's coming up. There's nothing much today anyway. So, yeah, we'll look at that tomorrow. Have a great week, everybody. Don't do anything stupid in this time of year. Be very careful with your trading. And we shall be back tomorrow morning to see what the Bank of Japan got up to overnight. You either might even still be talking by the time we do the show. Anyway, we shall see that. Thank you very much, Kay, as always.
Cheers,
we'll see you all tomorrow. Cheers.